It's not a guess. Michael Oliver isn't calling $500 silver because he wants attention. Michael Oliver isn't projecting a 600% move because the doom niche needs another headline. Michael Oliver isn't making this forecast because he stumbled into precious metals last year and got excited about the chart. And Michael Oliver isn't suggesting silver could hit $500 by summer 2026 because he doesn't understand how violent that would actually be. He's calling it because he has been measuring monetary metal momentum since 1975, 51 years. He called the 1987 crash. He called copper from under $1 to over $4 between 2003 and 2011. He called lead's structural confirmation in 2007 before it nearly tripled in 18 months. He called silver at $100 when silver was at $40. And he's now publicly stating, on multiple recent interviews, that silver's momentum readings are stronger than either copper or lead at the comparable stages of their bull markets. That's the credential. The forecast is $300 to $500 silver, potentially by summer 2026. From the current $73, that's a multiple between 4.1x and 6.8x. The headline, 600% incoming, isn't an exaggeration. It's the midpoint math of the actual call from one of the most credentialed momentum analysts in the industry. Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through exactly what momentum structural analysis is and why Michael Oliver's methodology has worked for 50 years when most technical frameworks fail. I'm going to show you the silver-gold spread dynamic he keeps pointing to, the relationship that doubled from 1% to 2% earlier this cycle and is now positioned to do it again. I'm going to give you the historical analog Oliver himself uses, gold's 8x bull market pattern from both 1976, 1980, and 2001, 2011, and what that implies for silver if the same multiple applies to the current cycle. And I'm going to give you the 4 signals that will tell you whether the summer 2026 timeline is converging or whether the move stretches into late 2026 or 2027. Quick favor before we go further. Subscribe. If you want clean breakdowns of structural momentum setups when they actually matter, not hype, not cheerleading, just the mechanics, hit the bell. Major monetary metal moves don't announce themselves through press releases. They announce themselves through momentum structures that break before price does. Let's get into it. Let me start with Oliver's methodology, because every claim about $500 silver that doesn't start with the methodology is fantasy in a louder voice. Michael Oliver founded Momentum Structural Analysis in 1992. The methodology, which he calls MSA, doesn't track where price is. It tracks the force generating the move. Oliver converts price into a momentum-style oscillator that measures how far price is above or below a moving average. And crucially, he then applies trend lines, ceilings, and floors to the momentum readings themselves, not to the underlying price. The thesis is simple. Momentum tends to break first. When momentum structures break support or resistance, the underlying price typically follows within days or weeks. Major turns show up in momentum before they're visible in conventional price charts. The methodology has a track record that even mainstream finance acknowledges. Oliver called the 1987 crash. The Wall Street Journal profiled his framework in 2015 as tracking trends that have been building for a long time. When silver was at $40 in 2024, Oliver's models pointed to $100. Silver subsequently hit $121.79 in January 2026. When copper was struggling under $1 in 2003, his momentum readings flagged the structural breakout. Copper went to over $4 by 2011. Lead got the same signal in 2007. Lead nearly tripled in the following 18 months. These aren't claims made after the fact. These are documented calls published in advance to MSA subscribers. Oliver entered the futures business at E.F. Hutton in 1975. He developed MSA through the 1980s, formalized it in 1992 for institutional clients, and opened the methodology to retail subscribers in 2015. The methodology has been continuously tested across 5 decades of commodity, equity, and currency markets. His batting average is not perfect, no methodology is, but his major calls on monetary metals over the past 25 years have a hit rate that justifies the attention current calls are receiving. So here's the first lesson. When a 51-year veteran with documented prior calls on copper, lead, gold, and silver publicly states that silver's momentum readings are stronger than copper or lead at comparable stages, and that copper subsequently went 4x and lead nearly 3x from those signals, the appropriate response is not to dismiss the call. The appropriate response is to understand the methodology well enough to evaluate it independently and then position accordingly. Let me get more concrete about the silver-gold spread, because this is the specific mechanism Oliver keeps returning to in every recent interview. Picture an MSA subscriber reviewing the proprietary charts in early April 2026. He pulls up the silver-gold spread, calculated by dividing silver price by gold price and expressing as a percentage. Through most of 2023 and into early 2024, that spread sat around 1%. Silver was approximately 1% of the price of gold. By Oliver's reading, that level represented historic undervaluation, only matched during the early 1970s and the deep deflationary bottoms of the 1990s. The spread had compressed because gold rose faster than silver through the 2022-2024 sovereign accumulation cycle. Then, in April and May 2025, something changed. The silver-gold spread doubled from 1% to 2% in approximately 2 months. Silver wasn't just rising. It was rising faster than gold for the first time in years. That doubling, Oliver argues, is the structural signal that initiated the current bull market. It's the same kind of relative strength shift that preceded silver's 1979-1980 move, when the ratio compressed dramatically, and silver's 2010-2011 move, when the ratio went from 80 down to 32. Now the math on what comes next. Oliver's framework projects the silver-gold spread reaching 3% to 6% during a sustained metals bull market. At a gold price of $5,000, a 3% spread implies $150 silver, a 5% spread implies $250 silver, and a 6% spread implies $300 silver. At $8,000 gold, which is Oliver's reference target if gold matches its prior 8x bull market multiples, a 4% to 6% spread implies $320 to $480 silver. That's the math. The $300-$500 range isn't a wild prediction. It's the silver-gold spread normalization scenario applied to a gold price that, by Oliver's historical framework, has substantial further upside. Oliver has been explicit about why he expects the spread to overshoot historical norms. His view is that silver has been suppressed for decades through paper market mechanisms, naked shorting, margin manipulation, coordinated central bank silver sales in the 1990s. Whether or not you accept the suppression thesis, the consequence in his framework is the same. When artificially constrained markets break free, they overshoot to the upside as the suppression unwinds. Silver doesn't just reprice, it overshoots, because the market is correcting decades of distortion in a compressed window. That's why his upper bound target reaches $500 rather than stopping at the historical spread ceiling. So here's the second lesson. The $500 silver call isn't a price target pulled from nowhere. It's the output of 3 converging frameworks. Gold's historical 8x bull market multiple applied to a $1,050 starting low, the silver-gold spread normalization toward 3 to 6%, and the overshoot premium from unwinding decades of suppressed pricing. All 3 frameworks need to be approximately correct for the upper bound to materialize, but none of them are unreasonable on their face. Let me put the historical pattern under a microscope. Because Oliver's gold reference framework is structurally specific and the precedent matters, gold's first major bull market in the modern era ran from 1976 to 1980. The starting low was approximately $100 per ounce in 1976. The peak was $850 in January 1980. That's an 8.5x multiple over 4 years. Silver during that same window ran from approximately $4 to $49.45, an 11.4x multiple. Silver outperformed gold by a factor of 1.34x during that bull market. Gold's second major bull market ran from 2001 to 2011. The starting low was approximately $250 per ounce. The peak was approximately $1,920 in September 2011. That's a 7.8x multiple over 10 years. Silver during that same window ran from approximately $4.50 to $49.20, a 10.9x multiple. Silver outperformed gold by a factor of 1.42x during that bull market. Now apply the same framework to the current cycle. Gold's starting low was $1,050 in 2015. As of today, gold sits at approximately $4,738. That's a 4.5x multiple, barely more than half of the historical 8x average. If gold simply matches its prior bull market multiple, the target is approximately $8,500. Oliver has stated this directly in multiple interviews. He's not predicting $8,500 gold. He's pointing out that $8,500 gold is what the same historical pattern that produced $850 and $1,920 in prior cycles implies for this one. Silver's starting low in the current cycle was approximately $11 in 2015. At today's $73, silver has multiplied 6.6x, actually outpacing gold's 4.5x multiple in this cycle, but still well below silver's historical 10-11x bull market average. If silver merely matches its own historical outperformance ratio of 1.34, 1.42x over gold, and gold reaches $8,500, silver mathematically reaches $510 to $610. That's the $500 number. Derived without reference to Oliver's momentum methodology at all, the same target falls out of the historical multiplier pattern. Is the historical pattern guaranteed to repeat? No. Each bull market has unique characteristics. The 1970s drivers were stagflation and dollar debasement. The 2000s drivers were currency expansion and emerging market accumulation. The current cycle has both, plus structural deficit, plus central bank reserve repositioning, plus AI-driven industrial demand expansion, plus the largest oil supply shock in recorded history feeding directly into inflation expectations. The setup has more drivers than either prior cycle. That doesn't guarantee the multiple matches, but it argues against the multiple, coming in materially smaller. Let me give you the bear case fairly, because intellectual honesty separates this analysis from the noise. The bear case on a $500 silver target, meaning the scenario where Oliver's call doesn't materialize on his summer 2026 timeline, rests on several real possibilities. Gold may not reach $8,500. Most institutional forecasts put gold's 2026 target between $5,500 and $7,000, materially below the level required to mathematically support $500 silver through spread normalization. The silver-gold spread may compress further toward 1.5% rather than expanding to 3 to 6%, which would cap silver well below Oliver's targets even if gold rises. The structural deficit may resolve faster than expected through substitution, copper-based solar cells, semi-solid batteries, and through demand destruction from a stagflationary recession. Industrial demand could collapse if the global economy enters the deep recession that JP Morgan's oil analysis models. And finally, the summer 2026 timeline could simply be too aggressive. Oliver's call may eventually prove right on price but wrong on speed, with $500 silver arriving in 2027 or 2028 rather than this summer. These are real arguments. They're not crazy. The technical traders watching the chart see silver capped at the 50-day exponential moving average around $80 with a clear bearish technical pattern below that level. The most bearish forecasts on the LBMA panel, Bart Mellick at TD Securities calling $44.25 average for 2026, represent the opposite end of the analyst spectrum from Oliver. Both Oliver and Mellick have credentials. They cannot both be right. The honest answer is that nobody knows which one will be vindicated, but the gap between their forecasts is the asymmetric setup that defines the current silver moment. What the bear case doesn't disprove is the structural setup. Even if Oliver is wrong on timing and price, the underlying conditions that support his thesis, historical bull market multiples that have not been achieved, silver-gold spread that is only halfway normalized, deficit that's in its 6th year, central bank gold buying that's structural, are all real and ongoing. The thesis can stretch in time without breaking in substance. So ask yourself, when a 51-year veteran with documented prior calls on copper, lead, and silver is publishing $300, $500 silver by summer 2026, when his methodology has identified structural breakouts before they became consensus on 3 prior occasions, when the silver-gold spread doubled in 2 months in mid-2025, confirming the breakout signal, when gold has only delivered roughly half its historical bull market multiple in the current cycle, when central bank accumulation continues at structural levels, and when the structural deficit is in its 6th year, what does the current $73 silver price actually represent? A market that has correctly priced the setup, or a market that is structurally lagging the math Oliver and others are openly publishing? Now let's read the current action like a forensic report. The forensic case for Oliver's framework being on track is built on signals that have continued to develop through the 35-40% correction from January highs. The silver-gold spread has held above its breakout level despite the price correction, meaning the underlying relative strength signal that initiated the bull market has not reversed. Central bank gold buying continues at 850-ton annual pace, supporting the broader monetary metal thesis. The Shanghai Futures Exchange's ban on naked silver short positions, implemented in late 2025, structurally reduces the paper market's ability to suppress price, a development Oliver has specifically cited in recent interviews. The COMEX silver inventory has continued to drain, with coverage at 13.4%. The 2026 deficit projection has been revised higher to 46.67 million ounces. You would also expect, in a market where Oliver's call was demonstrably wrong, for other credentialed analysts to be publicly disagreeing. They haven't. Bank of America's bull case is $135,309, overlapping with the lower half of Oliver's range. Citigroup's stress targets reach $170. Robert Kiyosaki has called $200. David Hunter is at $180. The bull range from credentialed analysts is wide enough to include Oliver's lower bound. The disagreement isn't about whether silver goes substantially higher. The disagreement is about how much higher and how fast. So here's the cliffhanger. Oliver's $300, $500 summer 2026 timeline is the most aggressive credentialed call on silver currently published. It may prove early, it may prove on time, it may prove wrong on price, but right on direction. What it cannot prove is being structurally unsupported. The methodology that produced it has worked before. The math that backs it is reproducible. The setup it describes is real. The only open question is whether the inflection arrives this summer or whether the next leg up takes another 12, 18 months. Let me put the macro context around it. Because silver doesn't trade in isolation. Gold is at approximately 4,138. Central bank buying is structural. The Federal Reserve is in transition. Powell ends May 15th. Warsh confirmation path opened April 24th. The largest oil supply shock in history is in motion via the Hormuz disruption. The fiscal deficit is $1.9 trillion. Debt has crossed $39 trillion. Net interest exceeds $1 trillion. Penn Wharton's true fiscal gap is $100 trillion. The Trump administration is openly demanding rate cuts the data doesn't support. The structural conditions for accelerated debasement are present in every direction simultaneously. Each of these factors strengthens the case for Oliver's framework. Monetary regime changes accelerate metal repricing. Oil-driven stagflation accelerates metal repricing. Fed credibility crises accelerate metal repricing. Sovereign debt sustainability concerns accelerate metal repricing. Oliver's summer 2026 timeline coincides with the convergence of multiple macro catalysts that historically produce the kind of violent metal moves his methodology specifically identifies. The pieces are in place. The question is whether they assemble into the catalyst this summer or whether the assembly takes longer. Here are the 4 signals that matter more than any forecast you'll read this week. 1. The silver-gold spread, currently around 1.5%, having come off the 2% peak from earlier in the cycle. Watch for re-expansion above 2.5%. That's the technical confirmation that Oliver's framework is reactivating. A break above 3% would confirm the bull market is in its acceleration phase. 2. The gold's price trajectory toward $5,500 and beyond. Oliver's framework requires gold to substantially exceed its current 4,738 level for silver's spread normalization to produce his target prices. If gold breaks $5,500 cleanly, the upper bound on Oliver's silver target activates. If gold stalls below $5,000, the silver target compresses toward the lower bound of $300. 3. Silver above $80 on a weekly close. The 50-day exponential moving average has been capping rallies. Oliver has publicly stated that $80 on a weekly close is the technical breakout trigger. Above that level, the next major resistance is the January high near $121. Below that level, the consolidation pattern continues. 4. Mining stock leadership. Oliver pointed out in April that the silver mining ETF outperformed physical silver, gold, and GDX through Q1 2026, while the S&P 500 declined 6 to 7%. Mining equity strength historically precedes spot price strength by weeks or months. If silver miners continue to outperform spot through Q2, the underlying institutional accumulation is confirming Oliver's framework in real time. Now, I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a silver price for September 30th, 2026, 5 months from now, which captures Oliver's summer timeline. Commit to a specific number, $150, $250, $300, $500, or do you think the bear case wins and silver remains below $90 through summer? Drop your number. Drop your reasoning. Don't hedge. Second, of the 4 signals, silver gold spread, gold's $5,500 trajectory, silver's $80 weekly close, or mining stock leadership, which one would most clearly confirm that Oliver's summer 2026 timeline is converging rather than stretching? This question requires real thought because the answer determines what you should actually watch over the next 90 days. Now, what should you expect next? Expect volatility. Markets approaching structural inflection points rarely move in straight lines. Silver could test $65 before reversing. Silver could spike to $100 and fail. The path to $500, if it materializes, will include shakeouts designed to remove weak hands. Oliver has explicitly warned that the volatility won't be comfortable. Expect mainstream financial media to continue treating $500 silver as fringe regardless of Oliver's track record. The institutional incentive structure rewards consensus and punishes price targets that imply currency failure. By the time the financial press acknowledges that Oliver was right, the move will be in its 3rd leg, not its 1st. And expect the move, if it materializes, to feel uncomfortable for everyone, including positioned holders. The 1979-1980 silver move felt like a parabolic blow-off to participants. Most got out too early or too late. The 2010-2011 silver move felt like a generational opportunity that was running out. Most got out near the top because the move felt unsustainable. The 2026 move, if Oliver's framework is correct, will feel similar. The investors who capture the full move will be the ones who understood the framework before the price proved it. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what the structural setup actually is. Silver is at $73. Michael Oliver's call is $300 to $500 by summer 2026, based on momentum structural analysis. Gold's historical 8x bull market multiple implies $8,500 from the current cycle low. Silver's historical 1.34, 1.42x outperformance ratio applied to $8,500 gold implies $510, $620. The silver-gold spread normalization framework supports the same range. Oliver's prior calls on copper, lead, and silver have hit at the levels his methodology predicted. The 600% move is what the math produces. The summer 2026 timeline is what his methodology suggests. Amateurs watch the price. Pros watch momentum structure, relative strength, and the historical multiples that produce the math. The amateur tape says silver is consolidating at $73. The professional tape, including Oliver's MSA framework, says the consolidation is the staging phase for the next major leg. Silver has been monetary metal for 5,000 years. It has priced every major currency debasement cycle. Each prior bull market in modern history has produced a multiple that exceeded what the consensus at the time considered possible. Oliver's $300, $500 target is the application of those historical multiples to the current cycle. It may prove right, it may prove early, it may prove conservative if the macro setup intensifies further. What it cannot prove is structurally unsupported by the historical record. So here's the clean summary. Silver is at $73. Michael Oliver's MSA framework targets $300, $500 by summer 2026. His credentials include the 1987 crash call, copper 2003, 2011, lead 2007, and silver at $100 from $40. The silver-gold spread doubled from 1% to 2% in mid-2025, confirming the breakout signal. Gold's historical 8x bull market multiple from a $1,050 low implies $8,500. Silver's historical outperformance ratio applied to $8,500 gold implies $510, $610. Central bank buying continues structurally. The structural deficit is in its sixth year. Shanghai banned naked silver shorts. COMEX coverage is at 13.4%. The macro backdrop intensifies the case rather than weakening it. This is where the serious holders of monetary assets separate from the tourists. The tourists watch the price. The serious holders watch the methodology. If you want the next breakdown, the moment the silver-gold spread re-expands, the moment gold breaks $500, the moment silver closes above $80 on a weekly basis, the moment Oliver's framework converts from forecast to confirmation, subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the financial press realizes Oliver was right. Drop your September 30th silver target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.